Dow and S&P on pace for their worst weeks since June of 22, as we are at session lows here at 51.56. Bob Dahl joins us, Crossmark Global CEO and CIO, talk about this ongoing and enduring sell-off period. Bob, good to see you again. Thanks for joining us.
Hi, Carl.
How do you construct a playbook, given some of the rugs that have been pulled?
So I think in the waterfall declines, you pay attention to the technicals. The fundamentals matter, but technicals first. We've only begun to see the put-call issue become problematic. It's been very calm until the last couple of days. Credit spreads until the last few days have been pretty tight. Now you're starting to see in both cases things open up a bit. So there's some capitulation creeping into the market. At some point, we will get a tradable rally. But we're not out of the woods. Probability of recession has gone up. We're using 50%, started the year at 25%. Earnings estimates, even before all this noise, Carl, in our view, were too high. Now for sure they have to come down. So I'm not convinced we've yet seen the lows in the equity market.
So with all of this sort of scary talk and recession worries and everything, if you were not adequately prepared or selling into Liberation Day, what do you do now? Is it too late to reduce exposure?
If you're way overweight equities, I don't think it's too late to back off. I will say in my portfolios, particularly the ones that I have to be fully invested, Sarah, I am beginning to lean against the wind. For example, buy a little NVIDIA, sell a little Coke. Doesn't mean all of it, but Coca-Cola is now selling, I'm looking here, 24 times forward earnings. In NVIDIA, 21 times. I think NVIDIA's long-term growth rate's higher. I know that stock's technically damaged. I get all of that. But buying a few banks, selling some food and beverage at the margin. Now, if you don't have those things coming in, you can't really sell them. But trimming back on the stuff that is done so well and buying some of the things that have gotten damaged so good at the margin, I think makes sense.
Just because things have gotten cheap, is what you're saying.
Yeah, but they've gotten a lot cheaper, and we don't know for sure we're going to have a recession or not. And if we do, how much are we going to mark down earnings? Look, I can be really bearish. Let's suppose earnings this year are $250 for the S&P, which isn't a full recession. It's just economic weakness. And I get worried about multiples, and so do I put an 18 on that? Do the multiplication. That's a 4 handle on the S&P 500. If we have a recession, we will sure see a 4 handle.
Right. Bob, we were already keeping an eye on the lower income cohort and credit quality and delinquencies on autos and so forth, which we still are. But now we got to worry about the wealth effect and the top 10% of earners who do half the spending in this country. And I wonder if you would even touch a consumer name at the high or the low end.
It's back to the list I just gave Sarah. I'm nibbling on them, not trying to be a hero. But I think some of those stocks have been damaged pretty hard where their fundamentals are in really good shape. Look, high end, yes, going to get hurt a little bit. We really have to focus, as you know, on middle income consumers. And they were squealing before all this period, beginning to even see some signs of taking out credit card balances, et cetera. So economic weakness is for sure coming. The employment report didn't say that today, obviously. But stay tuned.
Yeah, I mean, what about the argument that margins were near record highs? Companies have been in hiring mode. They've been in really good financial shape. We got that confirmed in the jobs report today. I mean, how much of a cushion do you think there is here?
Not a ton, Sarah. Look, businesses and individuals, when they don't know the rules of the road, and we've had a period of maximum uncertainty, they pull their horns in some. They stop hiring as many workers as they were going to hire. They defer a project. Individuals, tone down their vacation plans. You know how that goes. Enough people do it, it becomes a self-fulfilling prophecy. So economic weakness. Look, what's happened in the last couple of weeks? Earnings, economic growth expectations have come down. Call it by a point, to use a round number. And inflation number expectations have moved up. Call it by a point. That's not a good combination.
Finally, Bob, ex-tariffs, just on sentiment, I wonder, we were in this period on AI spend and CapEx where everyone was full throttle. You had to get the assets before the next guy. How much of that gets unwound? Would you be surprised to see some of the hyperscalers revise lower their CapEx guidance for the year?
I wouldn't be surprised at all. Look, I think this is a period that's going to be retrenching for almost everything. So might I spend a little less money? And remember, in January, we had the three biggest AI investors add $200 billion collectively to their intended spending this year. Some of that could be postponed over time without question.
Bob, session lows once again now. Dow's down 1,700 points, S&P down 276 points. Thank you, Bob. Appreciate it. Important day. Bob Dahl.
Hang in there.